Ryan and Priya bought identical houses on the same street in the same month. Same price, $350,000, same rate, 7%, same extra cash sitting in their account every single month, $600 they could send anywhere they wanted. Ryan sends his straight to the mortgage. Priya sends hers straight into an index fund. 30 years later, one of them is sitting on $478,000 more than the other, and it is not the one you think. Stick with me because by the end of this video, you will know exactly which one of them made the more expensive mistake, and the answer is going to change how you think about every extra dollar you send to your bank. Let's set this up fairly, because the internet loves to skip this part. Ryan and Priya both make about $62,000 a year. They both bought a $350,000 house with 20% down, so they are each borrowing $280,000 on a 30-year fixed mortgage at 7%. Their monthly principal and interest payment comes out to about $1,860. Same number, no tricks. After bills, groceries, and everything else, they each have exactly $600 of spare cash every single month. That is the whole experiment. Same income, same house, same rate, same spare cash. The only thing that is different is where that $600 goes next. Ryan takes his $600 and sends it straight to his mortgage servicer as extra principal. No brokerage account, no spreadsheet, just a bigger number chipping away at his loan every single month. He watched his parents carry a mortgage into their 60s, and he decided a long time ago that was never going to be him. Every extra dollar he sends is a dollar that stops earning the bank interest forever. That return is locked in the moment he sends it. Nobody can take it away from him, and nobody can shrink it if the stock market has a bad year. Priya takes her $600 and sets up an automatic transfer into a total market index fund. She does not pick stocks. She does not time anything. The money leaves her checking account on the first of the month and lands in the fund, and she does not think about it again until her quarterly statement shows up. She still pays her regular mortgage payment every month, same as always. She still owes the full $280,000. When people ask what she is doing with her extra money, she says index funds, and the conversation moves on pretty quickly because there's nothing dramatic to talk about. On day one, Ryan looks like the responsible one. He has a plan you can actually see. Priya has a confirmation email and a number that hasn't moved yet. If you stop the story right here, everyone would tell you Ryan is winning. And for the first few years on the surface, they would not be wrong. By the end of year one, Ryan has sent $7,200 in extra principal. He pulls up his amortization schedule and sees his payoff date has already moved up by almost a year and a half. He mentions it at Thanksgiving. His uncle nods approvingly. Priya's $7,200, meanwhile, has grown to about $7,800 with market returns. Nobody at Thanksgiving asks about it because there's no story there, just a slightly bigger number on an app she barely opens. Fast forward to year 5, Ryan has now sent $36,000 in extra principal. Because of how mortgage amortization works, those early extra payments punch far above their weight. A dollar of principal wiped out in year 1 erases every future interest charge that dollar would have generated across the remaining 29 years of the loan. His balance sits around $204,000 instead of the $233,000 a normal borrower would owe at this point. He's roughly $29,000 ahead of schedule, and his total home equity, counting both his extra payments and some modest appreciation, is somewhere around $115,000. Priya has contributed that same $36,000 into her index fund over those 5 years. At a historical average of about 10% annually, her account has grown to roughly $46,000. Her mortgage balance is right on the standard schedule, still around $233,000. And her home equity is lower than Ryan's, sitting around $95,000. But she also has that $46,000 sitting in a liquid account that Ryan simply does not have. At year 5, honestly, it is close. It depends entirely on what you choose to measure. But there's a mechanism working quietly underneath both of their decisions, one that almost nobody accounts for. And it is about to blow this comparison wide open. Here's the part that never gets talked about at the dinner table. The moment Ryan's extra dollar disappears into his mortgage, it stops working for him. It builds equity, yes, but equity is not the same thing as wealth you can use. Equity is money locked inside a wall. Ryan cannot use it to cover a medical bill. He cannot deploy it when the market drops 40% and everything suddenly looks cheap. He cannot move it into a better opportunity or start a business with it. The only way he gets that money back out is by selling the house or taking on brand new debt through a refinance or a home equity line. He has not eliminated risk, he's just swapped one kind of risk for another. Every dollar Priya sends into her index fund keeps compounding, every single month without pause. The return earns a return. That return earns another return. In year 5, this feels almost invisible, barely worth mentioning. By year 15, it starts to feel real. By year 25, the curve stops looking like a slope and starts looking nearly vertical. Compounding does not speed up gradually over 5 years, it speeds up dramatically over 25, and that is the entire engine driving this comparison. There is a second cost hiding inside Ryan's plan that almost nobody calculates, the real after-tax cost of that 7%. In the early years of a mortgage, the vast majority of every regular payment is interest, not principal. If Ryan itemizes his deductions and falls into the 22% federal tax bracket, some of that interest is deductible, which means his effective real cost is not a clean 7%. It's closer to 5.5% after accounting for the tax benefit. That is still a solid guaranteed return, don't get me wrong, but it is not the number people usually compare against the market when they run this debate. And here's the third hidden cost, the one that actually decides this whole thing, the ceiling. Paying down a mortgage early earns you exactly your mortgage rate, nothing more, ever. If the stock market has a year where it returns 20%, Ryan still only earns his 5.5% effective rate on that extra payment. If the market has a spectacular decade, Ryan's return does not move an inch. He has traded unlimited upside for a return that's capped the day he signs the loan. Over 30 years, if markets perform anywhere near their historical average, that ceiling becomes brutally expensive. By year 10, the gap is starting to show itself clearly. Ryan has sent $72,000 in extra principal over the decade. His mortgage balance sits around $158,000 compared to the roughly $208,000 a standard borrower would still owe. He's 8 or 9 years ahead of his original payoff date. His total home equity, including appreciation, is somewhere around $230,000. His investment account, meanwhile, is exactly zero. Priya has invested that same $72,000 over 10 years. At 10% average annual returns, her portfolio has grown to approximately $122,000. Her mortgage is still on the normal schedule, around $208,000, and her home equity sits around $140,000. Add her equity and her portfolio together, and her total net worth is roughly $262,000. Actually, slightly ahead of Ryan's when you count everything. But Ryan has nothing compounding anymore. Priya has $122,000 that's about to start accelerating hard. Now, let's jump to year 20, because this is where things get emotional for Ryan. He makes his final mortgage payment, a full 10 years ahead of schedule. The house is his, completely. No lien, no bank, no monthly obligation hanging over him. His housing cost drops from $1,860 down to just property tax and insurance, somewhere around $500. He tells everyone at the barbecue. Nobody forgets it. Priya still owes roughly $118,000 on her mortgage. She still writes that same check every single month. From the outside, at year 20, Ryan has clearly won. It is not even close visually. But look at what is sitting in Priya's brokerage account. $600 a month for 20 straight years at 10% average annual returns comes out to approximately $456,000. Ryan's investment account at year 20 is still sitting at zero. His house is worth roughly $620,000 with zero debt against it, so his equity is the full $620,000. Priya's house is worth about the same, but she still owes $118,000, putting her home equity around $502,000. Ryan is ahead in home equity by roughly $118,000, but Priya has $456,000 sitting in liquid investments that Ryan simply does not have, and that money has not finished growing. From year 21 to year 30, both of them go all in. Ryan, now completely mortgage-free, starts investing everything he has. His old payment of $1,860 plus his original $600 surplus comes out to $2,460 a month, going straight into an index fund. Over 10 years at 10% average returns, that grows to approximately $430,000. Priya's $456,000 portfolio keeps compounding untouched for 10 more years and grows to roughly $985,000. She is also still contributing her $600 a month during this stretch, adding another $82,000 on top. Her total portfolio at year 30 comes out to approximately $1,067,000. She finishes paying off her mortgage right on schedule during this final decade too. At year 30, both of them own their homes outright. Same house, same appreciation, same equity. That part completely cancels out. What is left is the investment account, and this is the number that does not make it onto anybody's thumbnail. Ryan's portfolio, approximately $430,000. Priya's portfolio, approximately $1,067,000. The gap between them, right around $478,000. Ryan got to live mortgage-free for 10 extra years, and that mattered to him. Priya ends the game with nearly $500,000 more in wealth she can actually access. That is the real, honest price of the trade Ryan made. Now, if I stopped the video right here and called this a settled argument, I would be doing exactly what half the finance channels on this platform do when they want the numbers to confirm what they already believe. Priya won the 30-year math. That does not automatically mean Ryan made the wrong decision for his actual life, and it would be dishonest to pretend otherwise. The guaranteed return is real. The stock market has historically averaged around 10% over long stretches, but it does not deliver that number every single year. In 2008, the market fell 37%. Between 2000 and 2002, it lost over 45% of its value across 3 brutal years. Priya's portfolio at year 20 could easily have been sitting tens of thousands of dollars lower if a bad sequence of returns hit at the wrong time. Ryan's extra principal earned his locked-in rate every single year with zero volatility. No exceptions, no bad years. There is also the reduced mandatory expense that Ryan gets to enjoy for an entire decade that Priya does not. From year 21 onward, Ryan needs far less income to sustain his life. He can take a job he actually likes instead of one that just covers the mortgage. He can absorb a layoff without touching his investments. Priya still has a mandatory $1,860 payment leaving her account every single month through year 30, no matter what her portfolio looks like that month. And there is default risk to consider. If Priya loses her income in year 18, she still has to make that mortgage payment or risk losing the house regardless of how healthy her brokerage account looks on paper. Selling investments to cover a mortgage during a market downturn locks in real losses at the worst possible moment. Ryan's house, once it is paid off, cannot be foreclosed on. There's nothing left to foreclose. So here is when paying off the mortgage early actually is a smarter move. If your rate is 7% or higher, the guaranteed return starts closing in meaningfully on historical market returns. And at 8% or above, it becomes a genuinely competitive comparison even before you factor in the value of certainty. If you are within 5 to 10 years of retirement, killing a fixed mandatory expense before your income drops changes your entire retirement math, because a person with no mortgage needs a smaller portfolio to retire comfortably. If your income is unpredictable, commission-based, or seasonal, lowering your fixed monthly obligations buys you breathing room that an investment balance cannot replace during a slow month. And if carrying debt genuinely disrupts your sleep or your decision-making, that psychological cost is economically real, because people who are less anxious tend to make better financial decisions across the board. Ryan and Priya both sat down and made a choice they believed was right. Ryan believed a guaranteed return and freedom from debt was the disciplined move. Priya believed decades of compounding was the obvious one. Neither of them actually ran the model all the way out to year 30 before they decided. They just picked the lane based on how it felt in month 1. Priya won the math, Ryan won the peace of mind. And the honest answer for most people watching this is almost never one extreme or the other applied without any thought to their actual situation. The real trap was never paying off the mortgage early, and it was never investing instead either. The real trap is treating a 30-year financial decision like it's a monthly payment problem, picking a side based purely on how it feels right now and never once asking what that choice actually costs you or gives you by the time you reach the finish line. So before you send your next extra dollar anywhere, ask yourself one question. Have you actually run your own 30-year number with your real rates and your real numbers? Because that number, not the one that feels good this month, is the only one that actually decides who wins this. Comment your current mortgage rate below, because I guarantee the person who comments right after you locked in a completely different number, and that gap matters more than most people realize. If this changed how you think about your own mortgage payments, hit subscribe, because this channel breaks down the real math hiding inside the financial decisions you make without ever being shown the numbers behind them.